Hello, everyone. I'm Olivia Higgins, and this is day 2 of our Moomoo Investment Outlook for 2024 as we gear up for a series of live webinar shows that we have in store for you because we're gearing up for the big event of this year, which is Moomoo Fest 2024. Now, we had such great energy and participation in the last few shows over the last day, and I think for this time, day 2, we want the same amount of excitement because we're going to have some giveaways and also quiz questions for you, okay? But if you want to find out what this next topic is all about, you're going to have to stay for the next video that we have crafted and created just for you. Enjoy.
Hello.
Apa kabar?
Welcome back, everyone. Once again, you're with me, Olivia Higgins, and this is day 2 of our Moomoo Investment Outlook for 2024. Thank you, everyone, for being a part of this series that we have crafted and created just for you. And now this is the first show of the day. So welcome, everyone, especially those who just joined in. I see some familiar faces and also some new ones. Do type in your questions already, and I'll pick the best ones for the end, okay? Before I introduce the topic and our experts for this show, please be reminded that everything is just for educational purposes, okay? So do not take anything as financial advice or any recommendations, okay? This is just a chance for you to learn and for us to be the bridge to such experts. And also it's a way for you to network, connect, and make sure that you ask your questions. And of course, the surprise quizzes, right? You all love that. Do participate as much as you can, but here's the twist. You have to listen carefully to what our speakers talk about because the quiz questions will definitely be related to that, okay? Let's hop right in for the topic for this particular live. Now, we're mid-2024. Where are we for Asia's fixed income space? What is the outlook and how can investors really utilize the potential window of opportunities in the current global market context? Now, today we're going to delve deeper into possible strategies you may leverage on for fixed income. So today is really just learning and really listening to the analysis as we transition into the second half of the year, okay? So the topic of today is Asia fixed income, a window of opportunity. So it's a lot of insights that you're about to learn, so definitely take notes and ask your questions. I want to start seeing the questions coming in from the start. So with that, I would like to introduce from UOB Asset Management, welcoming to the show, let's invite Head of Fixed Income Asia, Joyce Tan, and VP of Intermediary Sales, Edward Pai, everyone. Hi, Joyce. Hi, Edward.
Hello, Olivia. Good to see you again.
Hi, Olivia.
Welcome back,
Good afternoon,
Edward.
everyone.
Hi, Joyce. Hi. Yes, thank you so much for being on this live show with us for the next 60 minutes. We're really ready to unpack what you're about to share with us. Now, for those people who are new, especially with Joyce joining us for the first time on this live, thank you so much. Do introduce yourself and also tell us about the objective of today. Joyce?
Hi, good afternoon, everyone. I'm Joyce. I'm from UOB Asset Management, and I'm head of the Asia Fixed Income. I oversee the Asia-focused portfolios, and more specifically, I'm the portfolio manager of the United SGD Fund. Thank you for having me on board. Thank you.
Thank you, Joyce. And yes, you brought up the key word there. We can't wait to learn more about that particular fund and also how they can re-strategize and leverage on that to seek out that potential opportunity as we go into the second half of the year. Now, Edward, you are a regular on the shows. For those who don't know you, do introduce yourself.
Yeah, I'm quite regular here in various topics, various portfolio manager. Yes, I'm actually Edward from UOBAM management as well. So I actually in the intermediary sales team. So I basically handle the relationships with the digital platforms, the IFAs, or what we call the independent financial advisors, all these different channels that we do actually work with in terms of our UOBAM solutions for the clients out there. So definitely happy to be here with our one of our best partner, Moomoo Singapore. Always excited to see and be on this show as well. Yes.
Thank you so much, Edward and Joyce. So to start off our fireside chat, and again, people with questions related to Asia fixed income, please drop it in straight away. We'll pick out the best ones at the end, okay? And also there'll be surprise quizzes. So definitely pay attention to the next half of what we're about to share. Now, to start off, again, we covered a bit of intro and also the topic of Asia fixed income, a window of opportunity. Now, with these titles, right, perhaps to start, could you just explain, a bit more on the objective of today, what people can learn, and some key insights and information that you'll be sharing today? Perhaps Edward?
Yeah, okay. So I think, before we actually or we start, it's always good to understand what is the objective of today's webinar, what we're going to actually share. So I think right now what you're seeing is, it's really a prime time for us to basically look at where interest rates are today. A couple of 2 years back and all, the interest rate was really low. But today, if you look at it, just look at SORA, right, which is the index for Singapore interest rate. It has actually risen up to about 3.67, right, where you see in the chart itself. It has actually kind of shot up, right? The last time that we see this kind of rates was actually many decades back, maybe when I was still a young kid, right? But what happened today is that because of this high interest rate as well, you're seeing a lot of attractive, risk-free kind of MES bills, T-bills coming in at really good attractive rate as well. And because of this all-time high interest rates, you are also seeing fixed deposit. And of course, over the past 2 years, in the newspaper, in the media, and of course on the financial platform like Moomoo, we have been hearing a lot about T-bills. We've been hearing about, money market funds, cash funds, and they have been actually giving that kind of interest rate, which is really attractive right now, right? But at the back of it, right, once these rates actually start to increase as well, what happened is that I have mortgage loan and all this, and that start to increase as well. So I was just actually looking at the mortgage rate at recently, and even our own UOB bank mortgage rate was actually 3 months SORA, which is about 3.68 right now. It's actually plus another 70 basis point. You're paying about 4% on the mortgage rate. So, even with T-bills and all this, I think there are some expenses that doesn't cover all these interest rates. So, in that stance, and of course, our inflation, okay, is also high, right? And naturally, when I look at the latest, the core inflation data from Singapore, it's actually at 3.1. So in the next slide, what we are basically saying is that, there's high inflation, you got to pay your mortgage bills. And right now, when you look at the cash and fixed deposits, it used to be high. But let me tell you one thing. I think a couple or 1 month back or a few weeks back, UOB Bank was the first bank to basically cut the interest rate. Right now, if I look at the interest, the rates on the deposits, right, it's actually at, if I'm not wrong, it's about 2.7, 2.8 on a fixed deposit. So it has actually come down, right? So from there, where do you actually step up? Of course, you say, oh, you have your MES bills, you have your money markets. Right now, MES bill, if I look at the MES bill of 6 months, 12 months, they're roughly about 3.5, 3.7. But from here, where do you go, right? Where do you go? Because there's also one thing where you have probably heard it that, in the market, we are probably in the higher for longer regime, and that's basically going to stay, right? Last year, at the end of the year, when we look at Fed, where they were actually saying that, oh, they might cut rates, market was actually very bullish. expecting 5 to 6 cuts. But today, market had actually been more aligned with the Fed, and then Fed is actually saying that there's only going to be one cut and probably 25, 50 basis point kind of thing. So in that end, we are going to be in for higher for longer. So from here, how do you actually get higher yields? Just by taking on a little bit of risk, a little bit more risk. So that's why today we want to actually share in the next slide, right? Talk about short duration Asia high quality bond, right? Or our bond fund basically is the United SGD, where we have Joyce here to which she manages it, and she will be the best person to basically tell you the insights on the Asia fixed income, and it's actually really interesting. So what is United SGD all about? In the next slide, basically this is a short duration bond fund where we actually invest into investment grade bonds, right? The main objective of the fund is basically to achieve a yield enhancement over deposit over the long-term period, and basically this fund is for you to actually invest and sleep well at night, right? And of course, we do have very strong, consistent track record. Okay, we actually picked high quality bonds with very attractive yield pickup. We also protect the downside in the midst of market instability, and of course, there are distribution classes where you get payout in those classes as well. So that is what United SGD is all about. And in the next slide, where we are seeing extremely attractive pickup in terms of the risk and reward return is our United SGD. So I have actually looked into done the yields of the different local currency fixed deposits as well. And Singapore dollar fixed deposit, if you look at it, it's actually at 2.7. MAST 1-year T-bill, which a lot of clients are very interested, is at 3.57. But we actually give a little bit more yield. So you could actually, stagger your portfolio in terms of your bonds to basically have that yield pick up. So that is basically what we want to talk about today. We want to actually teach Moomoo investor out there, how you can go out there to actually pick up on the attractiveness of the yields by just taking on a little bit more risk. Yes.
Right. Thank you for laying down the context and also the core questions that we already have coming in, Edward, for this particular fund. Now, you covered what is United SGD Fund, right? But I think the next level, the next step, and we have users already asking this question, could you just elaborate a little further on the reasons for why they should just even consider the United SGD Fund?
Right. So I think the first thing that is actually basically 3 points. One is basically, you have a very consistent return. The second one is high quality bonds with attractive yield pickup. And the other third one is basically protect downside in the midst of market instability. So I'm just going to go through each 3 points because they're really important. What you are looking for is something that is safe, right? At the same time, you want to have a very consistent track record. So this fund basically started in 1998, right? And all the way until today in 2024, right, there was only 2 times that we were actually negative, in the sense that it was in 2008 and basically in 2022. Now, 2022, the reason is basically because that was actually what we call a wet year, in the sense that both equity and fixed income didn't perform, right? But even so, when the other fixed income classes were down about 6, 7, 8% or even more, or global equity was actually down 20, our fund was actually only down 2.3%. And in 2008, when it's global financial crisis, we were actually only down like 64 basis points. And throughout that whole 98 to 24, that's about 26 years, 24 out of that 26 years, 24 years, we were basically positive. And today, year to date, we are positive as well. So in that sense, we do have the consistent track record with, of course, good returns over here. So the fund itself is basically more of a, what we call very stable in that sense as well. And in the next slide, if you look at it, we even break it down even into, in different, in terms of the different months. So the number of months since inception, right, there's about 311 months. And the number of positive months that we have on a monthly breakdown, right, is actually 264 months. So we only have 15% out of that, which is about 47 months. It was in the negative months, right? And if you look at it, out of the 47, we never had and ever had 0%, there was actually a loss of more than 2%, right? In terms of 1%, it was only 4 months. So yes, of course, because this is a short duration bond fund, basically there will be ups and downs, but overall, right, it actually provides you a very consistent and stable positive returns, right? And why is that so? Because if you look at the number reason 2 in the next slide itself, we are looking at a very good high quality bonds with strong yield pickup. If you look at it, the average credit rating of the bond is basically, of the fund itself, is actually A minus. In a sense, we actually have 98% into investment grade allocation. So for the investors out there who see this word credit rating, right? They might be wondering what is credit rating all about. So maybe I just give you very simple explanation. So credit rating for bonds is basically like a report card for a bond, right? To tell you how likely it is for the bond issuer, such as the company or the government, to basically pay back the money they borrowed plus the interest. Of course, when you're talking about very investment grade bonds, they are the ones that basically get very good like A or B on the report card. They are very reliable. They have a strong ability to pay back the bonds. Basically, as the ratings goes down, right? What happened is that the bonds get riskier. So that means to say there is a higher risk of default. So that's basically what an credit rating is all about, right? It actually explains the report card for the underlying bonds. And if you look at it, ours is basically average credit ratings A minus. That means to say most of the bonds that we're going to basically have very good report cards on the credit quality, right? So that is one thing, and that is how we actually keep it very stable and consistent as well. And in terms of, in the next slide as well, where United SGD stands, right, comparing in terms of our savings, fixed deposit, plus the equities and the bonds out there, United SGD fund basically, comes in an area where, give you a year enhancement over the savings and fixed deposit. The risk level is just a little bit higher in terms of the money market fund, but it is. I will assure you one thing about this fund. This fund is not a super sexy kind of fund that will give you like an NVIDIA like of return, but it is more for clients, who are conservative out there or who wants to use this fund as a, portfolio stabilizer. They can actually use it to basically mitigate the risk. So that is where United SGD is in terms of the risk level. And when we look at the next, why are we actually looking at, in the earlier part, I say short duration. Why are we talking about short duration? So if you look into the next slide, right now, where the yield curves are basically is actually inverted, right? So what does inverted yield curve mean? That means to say the shorter duration or the durations, which is 1-2 years, are at the highest point of yield. So that's why the likes of your MAS bills like 3 months, 6 months, and 1 year, they are really at the higher level of the yields compared to the longer terms bond. And United SGD basically go into this kind of shorter duration bonds, and that give us the yield pickup, and that give us attractive yields as well, right? So that is the whole part of attractive yield pickup, right? And in the next slide itself, we actually protect downside during market volatility. So if you look at it, we have went through different market crises, right? If you look at global financial crisis, European debt crisis, COVID, and interest rate jitters, which is recently, if you look at how United SGD has performed, right? Compared to other asset class, our drawdown was actually much lower during uncertainty. So in that sense, we actually basically protect the downside, right? And the max drawdown that we have was actually is 3.8. That's from the highest to the lowest, right? So I think in that sense, this basically proves how stable it is during market uncertainty as well. And the next is, if you look at it, because of how long the fund has been in the market, we have actually tied through different market conditions. In the next slide, if you look at it, we have went through GFC, European, all different crises, but at each crisis, we actually come back even stronger, and it's actually delivering a very consistent return. So that is where our sense of protect the downside in the midst of market instability basically comes in. And and in the next slide itself, I take a lot of pride in saying this for our fund, right? The most important thing about bond fund is basically not to have any defaults in it. I mean to say, defaults in the credits and the underlying credits, but I'm very proud to say we do not have any default in the United SGD funds portfolio holding, ever since inception, despite us going through multiple crises in the market. And of course, the other thing is how do we actually, and we also, or rather Joyce, right? She actually implied the ladder bond strategy and the fund itself. So that is how, even during the years where the interest rates were actually going up, she was actually able to capture the higher interest rate, which is in the next slide, you will see it. So it actually explains in a rising interest rate environment, every year we probably had about 30% of the bonds maturing. And when that mature, we can actually look into other higher yielding bonds within the short duration space. So that is how we actually get a higher yield out of it. So in a rising interest rate environment, that's how we have been benefiting in terms of the yield pickup. So in that sense, in the next slide, I just want to show you some of the fund characteristics, right? The fund size itself is 1.6 billion. This is actually our flagship fixed income fund, average credit rating A-, and the duration we're looking at is basically on the shorter end of the curve. So those are the three reasons why, right? Consistent, you have high quality bonds with attractive yield pickup, and also protecting your downside in terms of market instability. So very, very, very simple three reasons. Yeah.
Thank you, Edward, for that. Next question then, would you be able to share further with us on how our active investors, particularly listening in right now, whether in-app or on our YouTube broadcast channels, how they can capitalize on the United SGD fund and build a portfolio in today's market environment?
Yeah, I think this is very important, right? How we come in to actually help the investors out there. Okay, so in the slide that you're seeing right now, of course, you have, basically everybody in this room or people who are watching are all have a certain level of the instruments that you are seeing right now. We definitely have cash, we definitely have fixed deposit, and I'm sure a lot of people out there are also invested into the money market kind of instruments out there, or even MAS bills. These are really good and safe, and of course, good yields, but where do you actually enhance those yields, right? So that you get a little bit more return on your portfolio, right? So what we want to say is that, you just have to take a little bit more risk, just a little bit. If you have seen the performance, you can actually step up now to basically get those yields to actually help you in terms of your inflation, in terms of, paying your mortgage, and that is actually helpful. And clients who are basically conservative, right? They're like, oh, I don't want to take too much risk in the market. This is something that you can actually consider, right? Because in terms of where the risk level is, it is supposed to give you that kind of, oh yeah, I can sleep at night by investing into United SGD. But those, of course, who are building a portfolio, a well vested portfolio, you have your equities, you have, other fixed income. Where this comes is basically a portfolio stabilizer because of the nature of the fund itself, right? So in terms of market uncertainty, it actually there's a part of the portfolio that's actually giving you some consistent and return as well as protecting the downside. So that's how investors basically play into their playbook, right? So I think that is where you can and you should actually step up now as well. And of course, if the rates are going to come down, like what the Fed is saying, there is one thing that's very attractive for United SGD because it's the underlying, high quality bonds. You can get to, apart from the yields, right? You can also get the capital appreciation from it. So that's another attractive feature of it. And from how we look at the market, we likely are to be already at the peak of where the interest rate cycle is as well. So that gives you an opportunity to take like what the whole title say, right? A window of opportunity for you to basically step up and enhance the use. Yeah.
I love those keywords there, stepping up and enhancing. So definitely replay this live webinar for yourselves if you missed out any key points that Edward shared. And I know we've got a few new people joining us as well. So again, right after the show ends, you can still watch the replay immediately for you, okay? My next question, despite the challenging global macro environment and increased market volatility, now Asian fixed income assets, we understand, has achieved respectable absolute returns, and we're talking about 6 to 7% here in 2023. Now, Joyce, this question is for you. As the portfolio manager, could you share your expectations for the United SGD Fund's performance in 2024?
Hi, thank you so much for the question. So for the 6 and 7%, we are really talking about US dollar terms. So I guess most of our investors are Singapore terms, so I will just focus on the Singapore interest rate return. So specifically for United SGD Fund, we closed out about marginally above 4% for last year. And this year, I'm hoping to clock another maybe above 4%. And just looking at the chart itself, what we are trying to show, as you can see in the 3 lines, the higher rate lines indicating the high yield, where you can get for your high yield interest rate, about 6% in US dollar term. And the black line is a composite between the high yield and the investment grade at about 6, slightly more than 6%. And just on investment grade itself, we are tracking around 5%. But all this in Sing dollar term is maybe about 1-2% lower. So what I'm trying to say is that compared to where we started last year versus this year, rates has sort of moderated, but not all is lost. Maybe we refer to the next slide. So in the next slide, you will see some wiggling lines. You see on the right-hand side, that's where we are currently, 2024, and where the darker blue line is where Fed rate is now. And of course, some of the market participants are making a lot of guesses every day when Fed rate is going to cut. But what is for sure, Fed rate is slightly peaked for now, and we are looking for a lower rate. But of course, the next question we'll ask is, are we then going back to what the kind of rates that we saw in the last 15 years? So many of us may be thinking, yeah, why not? Those are the normal rates, isn't it? But I'd like to say that, I'd like to suggest that it may not be truly that way, because if you track back all the way back to the 1990s, this is where we were back in 1990s. Of course, at that moment, the global economy was going through different patch, different stories, different inflation and economic growth. But there it was where we were now. So what I'm trying to say is that not all is lost. We can still capture the current high interest rate. And as a house, we think that rates, although may have peaked, but it's likely to stay elevated. And I say for now, it's a good balance between risk and return. Unlike the last 15 years, you may be buying the bonds, you're only just getting 1%. Actually, honestly, it's very miserable if you are an asset holder. So next thing for United SGD Fund, how we have positioned the fund. On the next slide, you will see that currently the fund is focusing on sector, which is in the financials, because we think that financials is a safe space, because financial will be the banks, with the insurance. These are the people that have good access to liquidity and needs if they should they want to do their refunding. Then the next part of it is that in terms of country, being UOB asset management, we are definitely where our homeland is in Singapore. So almost a quarter of the portfolios are exposed to Singapore, mainly due to familiarity. We have the ground here, you can touch those investments. We can even touch them physically, go and visit the malls, talk to the management locally, you don't really need to travel. So these are the positions that we have in the fund, and we think that the current position is conservative enough to capture the current high rate return. And going on to the next slide. Oh, do we have the next slide? No.
Sounds good. Thank you so much, Joyce, for that. And also, we've got some questions related to this point anyway. But just on this last slide that we have right now, do you have any just rounding up points for those listening in right now before we go into the last question for you?
Sure. And just following up on what on what we were saying previously, that the average rating of the portfolio is about A minus. In fact, if you look at the quality allocation, is rounding around A and triple B kind of credits. So again, this is where we find our value is, and we think that it's reasonable to capture the current opportunities that we have.
For sure. Thank you for that. So then the last question before we go into the demo for everyone and also the quiz giveaway and take some questions from the audience. Now, Joyce, to round up our chat, could you just share with us, what in particular sets your fund apart from your peers or anything else out there that's similar?
Yeah, I'm always being asked how are we different from my peers, but unfortunately I may not really look into my peers a lot, because sometimes I feel that a dress that look nice on someone, like maybe on Olivia, may not look nice on me. So it's very important that we need to ask ourselves where our strength is and what are the type of investors that we are helping to invest the money. So importantly for United SGD Fund, what we stress on is that we like to keep things simple. So keeping it simple, maybe I could suggest 3 S's. So first S, stability. So importantly, I would like my investors to experience a fund growth, a fund return performance that is quite stable. It won't be like some of the investment you see one day go up by 10%, the next day go down by 20%. You won't see such kind of performance in the fund. It's likely to be upward creeping, maybe at times a bit of bump, but it should be generally upwards. The next S that I have is being selective. As we show in the last slides, that how we have positioned the fund, we are not trying to buy the last dollar that is available there. And one suggestion for audience who are looking into buying into fixed deposits, into fixed income funds, do make your comparison, and most likely you'll be comparing who gives you the highest yield. But importantly, investing in fixed income is not like maybe like equity, you look out for the best return, because for fixed income, basically buying debt. So if you buy highest yield, you are actually buying highest risk as well. So importantly for us, as on a daily basis, when I'm looking at bonds to buy, I make sure that those are risk-adjusted returns, and I'm not buying the last dollar. And very selective on the type of credits that we buy into, maybe government, maybe strong access to the liquidity needs that they need, and also it has to be market leader. And the next S I have is sustainability. It has nothing to do with ESG, environmental, but being sustained in our strategy. I happen to see some of the questions being posted. They are asking about what is laddered strategy and asking some of the questions. That's why we have make sure that it's a strategy that's sustainable. Meaning we buy every year. I can buy up to 3-year maturity. Starting coming back to 2024, the beginning of this year, I'll buy bonds up to 2027 maturity. So in 6 months' time, you'll be crossing over to 2025. So I'll be buying to 2028 maturities. So these are very strategic, and it's very consistent strategy that we go through, so that investors are rest assured that the strategy don't change all the time. You don't really need to get much update from me, because you're likely to hear the same thing over and over again. So it's just being very simple, stable, selective, and sustainable. Thank you very much.
What a great summary right there. So I hope everyone really paid attention to the key words over there, simple, stability, selective, sustainability. These are really, really good for you to really revise for yourselves as well, and educate yourselves. Okay, I see a lot of great questions coming in. And of course, we'll pick the best ones for the end, okay? But for now, I would like to reward you for being here with us. So are you ready for quiz 1? And we'll have Joyce and Edward stay on the line here to give the right answer to everybody. Now, if you're ready for quiz 1 giveaway for those in-app, type in yes in the chat box. I already see people typing in yes. All right, if you're ready, type in yes. We want to see the yeses before we reveal the question. Okay, for those who are new to how the quiz works, this is how it will go. Okay, so the first 5 users who answer the questions correctly, you'll be awarded with 500 points. And that's quite a lot for those in the chat communities or regulars right here. Okay, so if you want to win this, you definitely have to have your fastest fingers first. But at the same time, and I saw this yesterday, some of you were really fast, but you got the wrong answer. All right, so you got to have to get the right answer and also answer as quick as possible. Okay, here are the details on how you can redeem it for after the show. Okay, let's gear up for quiz 1. I see everyone's ready. Okay, perfect. And in 3, 2, 1. How many numbers of negative months have with loss of more than 2%? Is it A, B, or C? Okay, we have all kinds of answers coming in the chat box. You'll have to answer A, B, or C, okay?
Hint is stability, consistent.
Yes, for sure. I mean, yeah, there's so much energy in the chat. I see a lot of answers still coming in. Okay, I'll give you 5 more seconds, everyone. Okay. And Edward, do us the honor.
The answer is drum roll 0.
The correct answer is 0. So those who answered the
A.
first answer on the tab right here, it's A, okay? Congratulations to those who walked away with our giveaway. And stay tuned because we have more giveaways throughout the rest of the show. Okay, Joyce and Edward, I'm going to quickly show how they can apply what they learned on the app itself. So we'll be back with you very shortly. Okay, those following through with the app, and if you've got that right in front of you, you're going to head over to your app right here to the front page, go to Discover, and you can see, I know a lot of you are tuning into the live on the first tab, but what you're going to do is you're going to go to Wealth. And I know some users face this issue before. You've got to make sure that your app is updated to the latest software. So definitely check on that, whether it's on the latest version of the app. Okay, so once you go to the Wealth tab, you're going to scroll, and you're going to go to Fund Houses. Okay, under Fund Houses, you're going to scroll down to U. And for the purpose of today, we're going to use UOB for sure. And you click on that, and you can see right here what we have been talking about, the United SGD Fund, okay? So these are all the available funds for this particular tab. So you can just navigate and see for yourselves which one you would like to focus on. But for today, we're going to focus on the first tab right here, okay? So this will take you to the overview page. And I've always emphasized on the amount of indicators we provide to you to really assess for yourselves, okay? So you can really track the performance, you can see the trend charts, but then you can also customize for yourselves what time frame you're looking at, okay? So everything is available for you and it's updated as well in real time or to the latest document. You can see down here the historical returns, the NAV for sure, monthly, quarterly, annual, anything that you need, and also the position details. You have to click on the arrow right there if you want to see more details on that, okay? Go to comments. This is what everybody in the community is talking about. And if you see anyone tag the United SGD Fund, you can definitely follow those people on the community. This is a great way to network with anyone else who is also aligned on that similar strategy, and meet like-minded people like yourselves tuning into the live show today, okay? So you can comment, like, share, whatever you need. Go to news, and here is where it will be updated. Right now, there's no data here, but of course, when there is, and if there's anything related to the fund, that is where they will accumulate all the news related to that, okay? So if you refresh it, something new comes up, it's really based on the trending words, the buzzwords, or anything that it fits into the ecosystem of that particular strategy. You go into analysis, and then you can see the portfolio, asset classes, sectors, regions, credit rating, maturity, bond type, all these keywords. If you want to find out more about it, of course, you got the learn tools on the app to really understand what you're looking into, okay? Here's the AUM, and then if you go to summary, which I always end off with because this is important for yourselves to look into further detail. So for example, you go down, you can see the fund documents and download it for yourselves under fact sheet or any reports that you need. They're all updated. Okay, so if there's anything else, you're going to have to return regularly to this tab. And to do so, because I know there's so much on the app that you can do, you can save this fund on the top right hand corner. So you just have to click on the heart symbol, and you can add it to your watch list right here. Okay, and you can see right here, of course, Joyce is on there, and you've got also more details on the overview segment of this fund. Okay, so do read it for yourselves. And I think it's really important, again, to watch the replay of this if you missed out on anything. And that's just a summary of how you can access it. But of course, for those who are ready to subscribe, all you have to do is click on the subscribe button. And those who haven't done the assessment, please do so before you hit the subscribe button and enter your amount for this fund. Okay, I hope that was helpful, but I do want to use the last 20 minutes to have our further giveaways and also answer some of your burning questions. Let's invite Joyce and Edward back into the room. Welcome back.
Thank you.
Okay, so this is the surprise. Are you ready for quiz 2 before we take the first question? Everyone else, type in yes in the chat box. Okay, Edward, you're going to have to give the right answer for this, all right?
Yep.
Okay, I can see everyone's ready with the yes. Okay, for quiz 2, 3, 2, 1. Has there been any default in the United SGD Fund's portfolio holdings since inception? Is it A, yes, or is it B, no?
Same hint, stability.
That's definitely the key word today, everybody. Let's see what everyone's saying. Okay, a mix of different answers again. Is it A or B? I'm going to give you last 5 seconds. Okay, and Edward, what is the correct answer?
The correct answer is A, no. There hasn't been any defaults in the United SGD portfolio since inception. Yeah, so we're very proud of that. Thanks to Joyce.
Right. Thank you. So the correct answer is no. And I know some of you on your screens are seeing that as B. So as long as you got the answer no, you got that correct. Okay. So thank you all for participating in quiz 2. And of course, if you got that right, the teams will be in touch. And of course, you can redeem according to the mechanics that we shared before. Okay, let's go to our first question that I've picked out for everyone here. So someone would like to know over here, right? Like from the beginning, I'm just picking it out from the start. What is the risk level of the Asia Fixed Income Fund? And also, could you share a bit more on the yield? Maybe, I know we touched on this, but I think maybe we could just give a bit more info on the yield and how long potentially to stay invested to generate a good amount of returns.
Okay, I'll just speak specifically for this fund, United SGD Fund. For last year, we clocked marginally about 4.3% return for last year. So this year, I'm hoping to keep around there because it seems quite possible now that we're 6 months into 2024. And coming back to your questions, how long should you stay there? Maybe just take myself, for example. I buy into my own fund, so I've been staying there ever since I placed it, maybe 5-6 years ago. So this fund, I would suppose it fit into different profile of investors. So if you're looking for long-term steady ones, instead of putting 5-year fixed deposit, 3-year fixed deposit, you can definitely consider this portfolio because it's stable in returns. And the good thing about buying into unit trust versus, say, buy a fixed deposit, you don't see your money until you premature uplift, or you wait until 3 or 5 years later. But for United, for this unit trust funds, you can sell at any time you like, as and when you need your cash back.
Thank you for that. Edward, do you have anything to add on
Yeah,
with the strategy component on that consistent returns point they
right.
brought up?
Yeah, so one thing that I would also want to highlight, because I realize that there's quite a number of questions on the yield. So the yield that we actually show here is basically yield to maturity. So for the audience out there, what is yield to maturity? Let me just share with you, yield to maturity is actually a very important feature for a lot of the bonds, be it single issuance bonds, or be it bond funds or bond ETF. It's really good to understand what yields to maturity are. Okay, so I put it in a very layman term, right? Yield to maturity is basically what you can basically expect to earn each year if you actually hold a particular bond until its maturity, the due, right? No, the deal is here is that you have interest payment, you get regular interest payment, like later bonuses for holding the bond. That's how bonds are, right? And then when bond mature, there's a final payback. You get your original investment bank. I mean, I'm talking in terms of as a bond, single bond level, right? So how yield to maturity works basically add up all those interest payments and any differences between what you have paid for the bond and what you get back, and average it over the years, right? So in a nutshell, what yield to maturity basically is actually give you a single percentage that shows you probably an average yearly return if you keep the bonds until the end. So it's just a rule of thumb, a handy way to see what you actually make from holding holding the bond. So that is what basically yield to maturity is. You will probably see in the T-bill, so on and so forth as well. So very important feature for you to look at. Right, so that is what yield to maturity is, and of course, like what Joyce has mentioned, basically these strategies for. Okay, I just want to keep it very simple. This strategy is basically for clients who want to invest in it and sleep well at night, right? And of course, taking that in step up in terms within the stability range to pick up the yields. So this is what this whole fund is all about. Yeah.
Thank you for that. Next question is related to headwinds. So what are the potential headwinds facing fixed income funds, and how can we possibly hedge with this?
I guess generally, if you buy into fixed income fund, there are two key risks. One is interest rate risk. So when rates were going up in the last 2 years, we can see that a lot of fixed income funds actually suffered because of lower valuation due to higher interest rate because of the indirect relationship between interest rate as well as valuation of their bonds. Another risk I would say is more critical. It will be a credit risk. So maybe say, for example, and very famous out there would be the China property sector. We saw almost 2 years of slow motion crash. Maybe the China government may not like me to say crash, but definitely it has not been very nice. It's been quite painful for those who invested in those space and sector. So specifically coming back to the SGD fund, that is why we wanted it to be stable. Remember the three assets I spoke about? So how is it being stable? Because it has a laddered strategy where it buys into 3 year only. So that every year I only buy about 3 year maturity. And remember, if I do it every year for 3 years, I will have about 1/3 of portfolio maturing in the first year, second year, and third year. So there will be a consistency. I'm not overly exposed to duration, because yesterday I just attended another session. Someone asked, what if Fed increases rate? I was saying, yeah, very good. That'd be great, because my coming maturity in my next 6 months, I'll be able to reinvest it in higher interest rate and clock better return. Then coming back on the other risk that I personally think is very critical, which is the credit risk. So it's very important that for United SGD Fund, the very fact that we buy up to 3 years maturity, that means we have better visibility of the companies and we can better assess them in terms of credit. How would you know how I will look like in 5 or 10 years' time? But you definitely will have a better visibility to know that in 3 years' time, I think I'll roughly look the same. So in the same way for credit, it's similar. We have the visibility, and therefore we have we can be more selective and we can be more careful and can make a more intelligent estimate of where this company will be in 3 years and whether I can get back my money upon maturity.
Thank you for that. So next question then, someone would like to know in terms of strategy, what is your advice for someone who is investing in fixed income? Should we do it more for diversification purposes as part of the portfolio, or does it have to be, does it deserve to be viewed on its own?
Well, I can't give specific advices. I'll use myself again. So what I do is basically I have a few buckets of money that I have. So I have some money that's of course in cash. I have some money in money market funds. That's a step out over the cash that I have. I can earn some return. Then the question that I'll ask is that, well, rates are high now. How can I then capitalize on these current high rates? Maybe buy into a fund like the HD fund. It doesn't have a duration risk. The credit risk is sort of managed, and I can get better return, and I can lock it in. That's very important because currently your money market funds or your MAS bill, you will realize those rates are coming down, and you really want to capture it at a high. Then, of course, these kind of returns are not sexy. I mean, just be very honest. So for myself, I do have maybe some exposure to equity. And for those who are braver out there, can try other kind of assets. So I suppose in all forms of investment, I personally think it should be well diversified. Look at your range of liquidity needs, because there could be things that you need now, you may need it 1 year later, 3 years later, 5 years later, and something that you are planning for your retirement, let's say. So depending on your profile, there should be different buckets within your overall portfolio. That's what I would personally think.
So next question then is about the funds as well, but within Asian markets. So in terms of how safe it is, or just someone who is a bit more risk adverse, I would say, as an investor writing in, how safe are the Asia fixed income funds, and which markets in Asia, and we can even extend that to emerging markets, are more promising in terms of the trade-off between risk and reward?
Well, as a portfolio manager in fixed income, I am definitely closer to the camp of being risk adverse, but certainly further away from investing just in purely fixed deposits. So for those audience that are currently just investing in fixed deposits, maybe MAS treasury bills, what I would recommend is this fund, the HD fund, because in Asia fixed income, how you can differentiate different risks is firstly the duration we're talking about. Do you hold it at buy short duration, or do you buy longer duration? And just now when Edward was showing, there's one the last 2 years when the portfolio went down under negative. Other fixed income was even worse because those are having 5-year, 10-year duration, and those got hit quite badly. And that is again coming back to my point about interest rate risk, duration risk. Then the next thing is credit. Again, stressing credit. So of course, you have to be very mindful that we try to focus on investment grade credits instead of venturing something else and maybe the high yield. So specifically coming back to United SGD funds, we are very much a investment grade focused funds, really buy investment grade. And I want to rehearse what Edward was saying right at the beginning. We want investors to sleep soundly, so I can also sleep soundly. I don't have to answer too many questions.
Yeah, so allow me to add on as well, Olivia, to Joyce, is that, one thing about fixed income is really interesting, right? Fixed income is not like your equities. Fixed income universe is actually really big. And the thing is that fixed income tend to be, in a way, if you're looking out for a single bond, fixed income or single issuance bond, one thing is in terms of the size, right? It's actually can be 250,000. So if you're let's say you want to have a bond exposure and you want to have a fixed income into it, you probably have to fork out 250,000. But in a unit trust structure, you can come up with whatever amount that you have or whatever savings that you have, you can actually go into it. So it's a lot more flexible in that way. And of course, even you buy a single issuance bond, there's one risk. What risk is that? There's a concentration risk, right? Concentration risk of that particular company that you're buying into. And sometimes you might think, oh wow, this company is giving a high coupon rate or a high yield, but there's many factors to it. One thing, what is the credit quality of the company? Do you have the expertise to actually analyze what are the credit qualities? What are the cash flow? All these kind of things that affect the businesses, whether are they able to repay the bonds or whatnot, right? And the other thing is also is that are they in the what level of credit quality are they in, right? That's of course the other thing. And also what kind of duration do they have, right? Sometimes they could be in a longer duration, but if it's a longer duration, it's a lot more going to be sensitive to where interest rates are moving, right? So how do you, as a retail investor, I would say, how do you actually manage that? It can be actually quite hard for normal investor like me and the rest out there. So leave all this hard work to the experts like Joyce. They have a credit selection team where they really study how the credit basically works, how the credit quality, what is the business model, so on and so forth, that they does all these heavy lifting for you so that you can basically sleep soundly at night. So I think these are some of the advice that I do have for clients as well. Yeah.
For sure. Thank you for that. Now we're going to take some last two questions, okay? So if you want your final question asked to our experts today, do type in right now because I'm going to round out the discussion before we go into the final takeaway and final quiz, of course. Now, the next question is, do you have any exposure to the Chinese market, in particular properties, or is there any, what is your methodology in particular for exposure to different markets?
Yeah, China is really interesting. It has been a lot of daily discussion. So as we know, for China property, they started with the G-rate line, and everything starts to tumble, slow motion crash. Sorry, it happened in the last 2 years. So the fund did have some exposure. So and we sold out of the marginal ones back in late 2021, and by 2022 March, we got rid of every one of them. The methodology, then we were asking, we were just wondering where is this going to end, because some try to argue that it can't be that everyone will get lost in this whirlpool. There must be someone to survive. So that is a possible outcome. But then as a team, we were discussing some of the environmental changes. In the last 2-3 decades of China growth, it has been growing on debt funding, it has growing on urbanization, and they have been growing on the back of China's strong growth. Are we going to see that in time to come? Then we decided highly unlikely. Then the next thing we asked about their business model. Can it be sustainable? Unlikely as well. Given the interest rate is going up, people are wondering about the business model. They're less confident. Can they refinance? They can't. Then the next one, of course, that goes up first will be the marginal credits. Then the next thing is like, what about investment grade? I would say that I have the privilege and the opportunity that I started my career in a very bad time in Asia financial crisis back in 1997. We see how cheap money gets into problem years later. And I joined UOBAM back in 2007, and that's when global financial crisis. And that, importantly, I learned that there's such thing called collateral damage. It's like a part of your ship is burning. You may be staying on the other side of the ship, but you have to imagine that you are actually on the same ship. If no one can put out fire, all of us is going down under. And next thing we think about, then what is the ongoing model for China? We think that China is in a way overbuilt. In the last couple of years, they have been talking about build first, they will come. Probably it worked in the last decade or so, but with aging population, with lower population growth, in fact, negative population growth now, are they really going to come? But what we also recognize is that there has been a lot of demand in the social housing demand. And we think that in that space of private housing, it could already reach a peak. And therefore, it may change your model of focusing on social housing. So we think that private developers is something that we need to be very careful of. That's why we sold out everything. And we think of collateral damage and there's a possibility of not surviving. And another reason why we sold out all of them because, as I mentioned about my last S, sustainability, we cannot sustain if we just hold 1 or 2% in China property and day in, day out, morning, afternoon, dinner, before I sleep, the moment I wake up, and the cycle repeats again because my business colleague will be asking me about this property, my investor will be calling me out to answer to them, do you have this? Do you have that? How are they doing it? So, and once I can tell you it was very intense and to some extent insane. So those moments was a memory that I will tell my grandchildren. But certainly it is once we sold out of it by March 2022, we can get back to sanity and we were able to look out for with a clarity of mind, we can steer the portfolio better and find other opportunities besides just trying to figure out where this China property is going.
Mhm.
Yeah, I
Thank you
remember
so
those
much for
time.
that. Yes,
Those time
Edward.
clear. I mean, I remember clearly. Those time when Joyce was really having a
Right.
a lot of time, hard time
Mm,
lah during those periods because we were actually with her in it together.
mm,
So there was a lot of hand holding to do as well. But I
mm.
think Joyce is very clear in the way that she handled things, the way that she handled the fund, and of course we were actually able to come out of it as well. And of course that actually helps in terms of the stability of the fund as well. So I think it's very key that how the portfolio manager basically manage the fund itself, how the team manages it, give that whole credibility to the funds. Yeah.
Absolutely. And thank you, Joyce, for sharing that so comprehensively. We have a lot of users writing in that they loved your sharing and also your great, honest insights right there. So definitely thank you so much for that. And I'm going to round this discussion up with a final question, okay, from someone who wrote in about what are the available resources or safety nets at UOBAM to help manage the fund effectively. Maybe you could just summarize for us.
Well, I suppose every investment comes with a risk. There will never be a totally comprehensive way to make sure that it's zero chance of getting a negative return. There is a possibility. That's why out of the years that we operate this fund, there's only 2 years that it went negative. And I suppose the safety net is what I've shared. We make investments simple. We make sure that the portfolio return is stable enough that you can rest, you can sleep. We make sure that we are super selective. We are not going out for the last dollar return for you. We're just making sure that we can realize the return for you. That's more important. No point telling you that I have highest return today, but I cannot deliver the return to you 1 year down the road. It's going to be very embarrassing for myself as well. So the next thing is being sustainable. I've been here for 17 years. We have worked on the basis that things are pretty much similar and manageable, and it's not intense pressure cooking and all the time and making things sane for everybody. So I suppose those are the network that we have to help you and to help us.
Thank you for that. Edward, any final thoughts on this before we do final takeaway for everybody listening?
Yeah, I think one thing is also for us, reputational risk is actually important. So we definitely placed in risk parameters to basically manage how Joyce basically manage the fund, so on and so forth. So I think, and of course, we have more than 20 over years of consistent track record. That proves some things, right? And then it's only, I mean, I want to re-emphasize again, there's only 2 years of negative return, and that proves a lot, right? Of course, here we're not talking about a super high return, but at least like what Joyce and I have always said, you can actually sleep soundly at night. And that's where we are working hard for you while you're sleeping soundly at night. Yes.
Absolutely. Thank you for that as that final point. Now, before we round up and go towards the end, and I'll give you some QR codes for how you can attend Move Fest as well. Now, we're going to go into the quiz 3. Now, Edward, be ready to give the right answer, okay? So for quiz 3, if you're ready, type in yes right now. Type in yes in the chat box. Okay, great. And in 3, 2, 1. What is the average credit rating of a United SGD fund? Is it A, B, or C? What is the correct answer? Fastest fingers first, please.
The hint is the highest quality, the best credit report.
A lot of hints right here, everyone. I hope you're listening. Okay, we got all kinds of answers. Okay, now a bit more consistent. I'm going to give you 5 more seconds. Okay, and in 3, 2, 1. Edward, what is the right answer?
The right answer is A minus. That's the average credit rating of the fund. Yes.
For those who answer that, congratulations. And of course, redeem it accordingly in the app. Okay. Now, thank you so much to Joyce and Edward. Now, Edward, as a final point, Joyce will end off with you. But Edward, let's start with you on that final takeaway for everyone listening right now.
Very simple. Step up now with the 3 S's that Joyce has actually mentioned, right? Simple, sustainable, and basically stable. Yeah. Okay. That's for me. Step up now, guys.
Thank you so much. And Joyce, let's end off with you.
Yeah, I saw some question about our fund versus the money market, and coming back to what Edward's speaking about step up. It is time to step out from your money market fund. It is time to draw your money from your investment in MAS Treasury and step out to this fund, because you can't hold that yield for now. It's trending down, so it's important that you try to lock it now, at least for the next 3 years. Thank you very much with this fund.
Thank you so much. And that was Head of Fixed Income Asia and VP of Intermediary Sales, Joyce Tan and Edward Pai, everyone. Thank you so much, Joyce and Edward, for joining us today. And yes, hopefully see you at MooFest.
Thank you.
Thank you. And to everyone listening in, again, thank you for your great energy for day 2 of the live fun webinars that we have in store for you. And really, I think a lot of people join in halfway or towards the end. So it's okay. You can watch a replay right after this, okay? Wherever you're tuning in from. Be sure to follow us right here on the community page. So if you can see it right now, wherever you're tuning in from, click on Mooridge or scan the QR code if you want to stay up to date on the latest related to funds or even just latest news on upcoming live shows, okay? You can also have some access to event descriptions and also upcoming giveaways for yourselves. Definitely give it a follow. And of course, if you want to stay connected with me, myself, I'm always listening to your questions and what you want to know next for the upcoming live shows, especially as we transition into the second half of 2024. So even you heard just now, Joyce was mentioning that 2025 is pretty close. So if you're always looking for new ways to re-strategize, you have to follow us right here and you'll stay up to date, okay? And I'm always listening to you. So scan the QR code on the left and on the right, our social media pages, join our Telegram groups, keep up to date on our TikToks, Instagram as well, Twitter, YouTube, and Facebook, especially LinkedIn too. So just scan it here and you can choose whatever platforms you like to follow us. And next up, happening very shortly, is the next and final show for today. We're going to go into strategies for capturing income. So thank you once again for everyone's attention. But again, if you missed out on any opportunities today to win quiz giveaways, you can do so in the final show. And of course, keep leaving your questions because we'll be tracking what you want to know next, especially related to Asia Fixed Income for this show in the chat box. Okay. And as promised, Move Fest 2024. This year's theme, Thinking Forward, Mastering the Future. Do sign up if you're listening right now and haven't done so. It's going to be a big affair and a big event. So I really cannot wait to meet in person some of our community members who always come onto the shows. Definitely say hi and cannot wait to see you there. So yes, we look forward to seeing you for the next show and the final show for today. So definitely tune in about 1 hour, and we'll see you very shortly. Thanks again for joining us for Asia Fixed Income, the window of opportunity, and we'll see you for the next one. Once again, I'm Olivia Higgins.